All right, hello, this is Jim DeRocher from TrueView Financial. I hope you and your family are staying healthy and safe right now. I wanted to do this for you, this discussion today, because I know a lot of people I've been talking have questions about what to be doing right now with their investments. They're concerned with the pandemic, the volatility in the market, what to do with the election coming up. Hopefully you watched my other short video regarding the election and perspective on that. So what right now is going to be about is about a half hour or so about some perspective on how investments work and how you can make them work for you. And how you can put together an investment strategy that you can be comfortable with, that you can be confident in, and hope you can get to where you want to go financially. So let's dive right in. Let's take a look at some scenarios. Hopefully you can get a lot of information out of this. And if you have any questions, please email me. I'm actually working on gathering a bunch of questions from people and then doing a follow-up to this with all the questions, almost like a town hall style question and answer session. So please email me. You can email me directly, jdesrocher@mytrueviews.com. You can go to my website, mytrueviews.com, and just enter in a question there. And if we can get enough questions, we'll do a follow-up. So we'll get everything answered for you. But let's dive right in. So this first graph is a study of the markets. And I love studying the 90s and the first decade of the 2000s. And that's because the 90s are the roaring 90s, so the market was doing great. And then we had the 2000s, which had a tech bubble crash in it, as well as a 2008 recession. So during that time frame, the average equity fund investment from 1990 to 2000 earned 8% on average per year. The average investor investing in those same equity funds only earned 3% a year. So let's repeat that, is average investments earned 8% a year, average investor earned 3% a year. So how is it that the investments can be returning 8% a year, but people investing in those investments only earn 3% a year? Right, this is a major issue. We have to find the reason why for, become aware of it, and find a solution. Most people are earning a lot less than what they should be on their investment accounts. There's a huge gap here that we have to fill, and that's my challenge for today, to help you do that. So some of the consequences of poor decision making are consistent underperformance. And so Dalbar is an information company that does a study every single year of the long-term annual returns of the market and the average investor. So this green is what the market has actually done, and the red is what the average investor's done. And you can see consistent underperformance, like really bad. So we don't want that to happen to you, because your goals and your future, your retirement is on the line, your family, your hopes, dreams. So let's take a look at that. So what a lot of people do is, or ask me, is where's the best place to put our money? And they hope that that's going to solve the problem. So the Wall Street Journal actually wrote an article, the end of 2009, is the best stock fund of the decade. So they actually found an answer to the question, where's the best place to put my money? Was managed by investment guru Ken Hebner and the CGM Focus Fund. And from 2000 to 2010, the market was basically flat. Depending on what you invested in, was actually down for 10 years. This fund during that time frame rose more than 18% a year for 10 years ending in 2009. Really incredible. However, let's look at the next paragraph. I'm going to zoom in on this one. Is the average investor in that fund, average investor lost 11% a year during that time frame. That's according to Morningstar, who calculates those things. So there's a 30% difference from what this investment did to what the people investing in that fund did. Now, why is that? So what happens is, as things go up, people get really excited about that. So they want to get in. And then when things go down, you get nervous and you get out. So a recent example of that is Bitcoin. A couple of years ago, it was all exciting, and you heard about people making all kinds of money, and it was going way up through the roof. And then all of a sudden people were getting in and everyone wanted it. And then all of a sudden it dropped, and it's been down ever since. So people are afraid to ride out the market. They're not being patient and disciplined, and that's leading to dramatically underperformance and putting your goals and your long-term performance at risk. So figuring out what to do and why you're doing it is a big part of the problem. So we're going to take a look at 90 years of academic data that's won over 3 Nobel Prizes. So the first one we should look at is is the stock market broken? Is that why there's underperformance? So Eugene Fama won a Nobel Prize for efficient market hypothesis, which is basically telling us that the market does actually work, and that conventional methods of market timing, of trying to get in and out of the market, get out before it goes down, get in before it goes up, and trying to pick the best stocks or the best sectors, technology, or what's going to go up next, basically trying to predict the future, has actually led to really low odds of success. So they did a study of managers and how likely were they, or how actually real life data, how did they do in beating their benchmark index for 15 years. So what they found is these are the money managers on Wall Street. How often do they beat the market? Is only 19% of the time. So they were wrong. 80% of the time, the best of the best, the money managers on Wall Street who make millions of dollars doing this will only beat the index 19% of the time. Really not great odds of success. So what are the chances you have of actually picking the right stocks that beat the market? But what we're learning is the market actually works. So then what we should look at is, well, where does your performance of your portfolio actually come from? If it's not going to come from hiring a manager to actively pick stocks and bonds for you, where is it going to come from? So Harry Markowitz won a Nobel Prize for his study called Modern Portfolio Theory. And what they found was there's basically 3 determinants of where your performance actually comes from. The first one is market timing. So what's really interesting is only 2% of your whole entire performance actually comes from market timing. So this is like your ability to, right now with the election going on or the coronavirus crisis, is if you could find the right time to get out of the market and then also find the right time to get back in the market, or get out of technology and get into another sector, get out of small companies, get into large companies, things like that, get out of the US, get into Asia or international. Your ability to time the market over the long run only adds about 2% to your whole entire performance. It's almost insignificant over the long run. But what you're doing is taking on the risk of thinking that you can, or someone out there has a crystal ball of when to get in or when to get out of the market. Next is your ability to pick stocks. Is picking Apple is the right time to get in, or IBM's the one to get in, or Monster Beverage, or all these different companies out there, Amazon, versus just being in a diversified account. Is stock picking only contributes 4% to your whole entire performance. So think about it. You might hear about hot stocks from a friend or a family member or a colleague at work. And let's just say that you go with that and it goes up 20%. But in comparison, the whole entire market is actually up 20%. Was it that stock pick was a great investment, or was it just that everything was up? And think about it, you take a lot more risk investing in one stock versus just investing in the whole market. That's kind of what this is saying here. So what they found is almost all of your performance is based on how well allocated your assets are, is basically how well diversified are you. Can account for almost 94% of all of your performance. So what we found is over time, there's really 3 mistakes that most people make. Is stock picking, just trying to pick a couple of individual stocks investing, not diversifying. Market timing, trying to get in or out of the market. Like right now, let's get out of the market for the next month while the election happens and see what happens. Or back in 2016, as Trump got elected, and we don't like them, we got out of the market. Or if we did like them, we got back in the market. That's all market timing. That's a big mistake people make. Or what we call track record investing. What that is looking back, oh, well, this manager or this fund has a great track record in the past, and thinking that can continue to be that way in the future, which is actually proven to not be the case most of the time. Or technology has been great in the past, so it's going to be great in the future. Track record investing. The three biggest mistakes people are making are stock picking, market timing, and track record investing, and that's why it's leading to consistent underperformance. And for investing success, there's really only three rules. There's invest in stocks up to your risk tolerance, and then add in bonds to cushion volatility. Diversify globally, so U.S., international, large, small companies, and then rebalance. So what rebalance is systematically buying low and selling high. So if your stocks are going up and your bonds are slow and steady, as your stocks appreciate in value, you would sell stocks to buy bonds. Or if your stocks are going down and your bonds are going up, is sell the bonds to buy more stocks while they're low. That's what rebalancing is. And doing it systematically, not trying to time the market. So Eugene Fama won another Nobel Prize in 2013 for his hypothesis called the three-factor model. And what that's telling us is that over time, the stock market beats bonds. Over every 15-year time horizon, is 95% of the time the stock market beat bonds. Small companies beat large companies over 80% of the time in the long run. Value companies beat growth companies almost 95% of the time in the long run. And they added one recently, is high profitability companies beat low profitability companies all the time over the long run. So what this is telling us is we're looking at higher returns is investing in stocks, value companies, small companies, and high profitability companies. And a study showed us that if you invested $1 back in 1926 to 2014 and just left it there, your $1 would have grown to over $18,000 invested in small companies. And in large companies, $1 would have grown to $5,000. And in bonds, $1 would have grown to $135. Inflation would have been 13 times multiple over this 90-year time frame. So this is showing us that the market works really well. These returns are, you don't have to stock pick, you don't have to market time, you just have to be diversified and be invested. That's showing us that that's the most important thing. And this data doesn't come from me, but it comes from just science. These are all the great economics that have won Nobel Prizes that contributed to this data that I just had a fortunate opportunity to study with. And so what they're saying is the way you could be invested is globally diversify in everywhere that's black. So all these countries have a free and open market to trade and invest in, rather than just picking one or two on your own or being just in the United States and being invested in over 17,000 different companies. So this is what diversification means. Diversification is not being just an S&P 500 index fund that's only in one asset class, large US growth companies. They're only in one country, one asset class, and only 500 companies. Where you could be invested in over 45 countries and over 17,000 different companies. And when you invest like that, you're already invested in everything. So then you don't need to buy and trade all the time. You're already invested in a company that's going to do well. So you're getting the benefit of that. And you're much more likely to not fall trapped to the three common mistakes and follow basically just the three rules for investing successfully. Invest in stocks, diversify, and rebalance. So you might be asking, well, has that strategy actually worked? Has that science actually work? So this shows all the different types of asset classes that you can be invested in, and what we call structured investing, just following the science, what it's done, and what the index has done. And when you're really well diversified, you can see that there's a better return than the benchmark in every single asset class. And then you should also be considering cost, as the goal is to minimize your cost of investing. So it's a little known how much cost there is to investing actually, is when you're investing in funds or strategies, is there's four fees. Is there's an expense ratio, and the average fund has 0.8% expense ratio. There's transaction costs inside of those funds for investing. So every time they buy or sell, there's transaction costs. These are not disclosed to the client. And then also the internal taxes that happen from that buying and selling is about a 1% cost. The client doesn't see, it's buried. And then the average advisor fee in the industry is 1%. So the average investor is paying somewhere between 3 to 4% cost of investing. Now, if you understand the data and the research, and you don't have to pay an investment manager to manage your funds and buy and sell all the time, you can reduce your expense ratio. And if you're diversified and own 20,000 different companies, you don't need to buy and sell all the time, so your transaction costs are going to be lower. And then if you're not buying and selling all the time, then your taxes are going to be lower. Average advisor fee at 1%, your cost of investing would be significantly lower. And you have a much better diversified investment account. But the biggest problem I see out there is, even with that knowledge, is abilities for human beings to stay disciplined. So when I studied under these scientists and these economists, is one of the things they said is human beings when God created human beings, he created the worst investors possible. And that's because we're just not disciplined. Is more often than not, is we get in our own way. And our reacting can actually hurt our performance. So this is another study. If you invested $1,000 back in 1970 and just left it in there for 40 years, it would have grown to almost $90,000. Just $1,000. But let's just say one time, 1 month, over 40 years, your whole investing career, you made one mistake, or you market time just one time, or you say 2016 happened and there's a big election and I just want to get out of the market just for a month to see what happens. Is your $1,000 still would have grown, but if you missed just 1 month, it would have only grown to $21,000. So reacting and not being disciplined can really have a dramatic impact on how well your investments do. Here's a really interesting chart. I know it's hard to see, but what it does is show all the different asset classes from 2006 to 2015 and what they all earned in that year and what the average is. So not surprising that small companies did the best. There's only one asset class that actually has a negative return. And I want to ask you something. How often in the last 5 or 10 years have you heard about how gold is a safe place to invest? Or gold is a great hedge when the market's volatile? Or you should invest in gold or precious metals right now. From 2006 to 2015, the only asset class that was negative for the whole time frame was gold. Everything else over that time frame was positive. Gold was negative 16% on average per year during that time frame. So back in 2009, gold was up 35%, and that's when it's got like that's when we started hearing more about investing in gold. And gold's supposed to be safe. Look at down here. In 2007, it was down 18%. In 2012, it was down 23%. In 2013, it's down 63%. You would have lost over 80%, almost 90% of your investing in gold in just 2 years. 2015, it was down 31%. If it's supposed to be safe, I don't think anything that's safe should ever be down 30% or even 60% in a given year. So I want you to question the things that come up in the media or on the news. Is it really in your best interest? And is it even just really the truth? And gold's a horrible place to invest. So here's the best quote I found about how to have a successful investing experience. Is what you're seeing is that the markets work really well, and generally it's human beings getting in the way and making bad decisions that lead to poor investment experience. It's just learning to find a way to invest and learn what we can control and not control. Generally, you have a better investment experience than people that try to fight the market or try to time the market. Even in 2008, for example, you go back to, that was the last big crisis. From the top of the market high to the market low, the market was down about 55%. Following that, 1 year after that, the market was up almost 70%. And 5 years after the end of it, it would have been up over 200%. So even during that, you would have made all your money back and plus some if you were able to stay in. Another really bad time frame is a crash in 1987, Black Monday. So if you invested $10,000 at the very high, worst time to invest in 1987, you could have done 4 different things. And over the next 20 years, if you just got out because you lost so much, and said, I just got to get out, you lost 20% almost in one day. And so I just got to get out. Your 10,000 would have been 7,800. What if you just sold and said, you know, I'm done with investing, it's a horrible experience, and you move to CDs and you earn 5% over the next 20 years? I mean, that's pretty good. Is your 10,000 would have grown to 26,000. If you actually just wrote it out and just remained invested, your 10,000 would have went down, but it would have come back up 7-fold over the next 20 years. And if you remained invested and actually continued to invest when the market was down, just $200 a month in this example, look at what it would have grown to. So continue to invest when the market's down. You're buying when things are lower, and you're going to get a much potential for more growth. Important things are to focus on what you can control. And part of the things we do for our clients is just help them focus on that and where can we add value. So looking at science and the facts and the research, not just someone's opinions, letting the markets work for you. How can you lower expenses and turnover costs inside of your portfolio? And how can you truly, really be diversified, not just in one asset class and not just in one sector? And the most difficult thing of all is how to stay disciplined and bring confidence to what you're currently doing. So again, if you have any questions about what we just talked about, this is the basis for how to put together an investment strategy. Focus on what you can control. Let me get back here. And if you have any questions, please email me or please go to my website, send me your questions. If I can get your questions, what I'm going to do is I'll do a follow-up webinar like this and answer all your questions. I'd love to get 20 or so questions from everybody, and we can do a town hall style question and answer session. So please email me, j.derosha@mytrueviews.com. Please go to my website. There's a spot there. You can ask any question you like. I'll get that, and I'll put together a webinar to follow up on that. Anytime, we're offering complimentary consultations. If you want to talk about what to do right now, more than happy. It'd be my pleasure to do that for you. Once again, Jim DeRocha from TrueView Financial. The website is www.mytrueviews.com. We're here for your investing success and peace of mind. Thank you.